That's your money saying it's time for a McDonald's run. Because with new McValue at McDonald's, you get more than you expect. Like buy a 6-piece McNuggets and add a McChicken for just $1. Your money says let's go. Get more than you expect with new McValue. Prices and participation may vary. Valid for item of equal or lesser value.
Reality radio for a really great future. We're talking real money.
Welcome to a Monday. It's another short version of Talking Real Money, the podcast. I'm Don McDonald. Thanks for listening. And before I get to today's topic, I want to ask a favor. Call us. That's how this works. If you have questions about how to make money or save money or particularly invest money or avoid being ripped off by people in the money business, then you probably owe it to yourself and your family and your future to check things out every once in a while. That doesn't mean that we have all the answers. We don't. But we're sure as heck going to try and find the right answer for you. And I can assure you that the answer will be in your best interests as opposed to your broker's or even ours. It's easy to do. You can call us 24 hours a day, 7 days a week at 855-935-TALK and just leave your question on the answering service electronic thing. I get a copy of it, and I can put it right in the show, answer your question, put it on a future podcast. 855-935-TALK. And that will have to be the only way you talk to us for the next couple of weeks, because we're not doing the live show on Saturday, the 2nd of November, because we're preempted by a Washington Huskies football game. So this will be your one resource. You can also send in questions to our website, which is talkingrealmoney.com. There's just a contact button. Type it up. It comes to me. It's that easy. And I'll try to get those answered for you as soon as I can. Today's topic, hot funds. The kind of funds that friend of yours in the brokerage business is always trying to sell you. Well, I got to tell you, you're not the only one to whom people are trying to sell funds. In the investment advisory business, we get calls all the time. And I thought I would share one of those. I got a voicemail on a mutual fund, and I thought I would share that with you and then talk to you a little bit about what's wrong with this kind of approach and this fund.
Hi, this is Fabrice on behalf of Guinness Atkinson. Just wanted to do a quick follow-up with you. We sent you an email a few weeks ago about the Global Innovators Fund that we have at Merrill. This is the fund that has 31 equities in it. These are medium to large-sized companies that focus on innovation. And we prioritize U.S. companies, but we also have exposure to different geographical locations as well. This fund is for long-term capital appreciation. And performance-wise, we've done really well. Our 3-year annualized number is over 16%. And if you track it over 10 years, we're 13% annualized.
So let's take a look, shall we, at the, what's the name of this thing again? Guinness Atkinson Global Innovators Fund. The Guinness Atkinson Global Innovators Fund, it's been around for a while. It's got many years under its belt. And it is an actively managed fund. Now, Morningstar compares it to U.S. large cap growth funds. They say it behaves more like a U.S. large growth fund, so that's how they compare it. So that's how I'm going to compare it, because that's what they do. First thing I look at, it's just a nice way of looking at funds. You go to Morningstar.com, you put in the symbol, in this case it's IWIRX. Its expense ratio jumps right out at you. 1.25%. For a large growth fund, that's high. Well, heck, that's high for almost any kind of fund, but particularly for a large cap growth fund that only has about 30 stocks in its portfolio. We'll get to that later. He said in the call that their 3-year return was over 16%. Well, I'm not sure what time frame he was looking at, but over the past 3 years, through the 25th of October 2019, their 3-year return was 14.23%, which is almost 1.5% less than the category, than the large growth market in general, and 4% below the S&P 500. So I wouldn't be bragging a lot about that great return, particularly with the high expense ratio. Then we take a look at that 10-year return, and that in fact is over 13%, But again, I wouldn't be bragging because that's about in line with what the category does. And what you have to do, in addition to looking at the return, is you don't look at that in a vacuum. You look at what the volatility of that portfolio has been over those same kinds of periods. And the volatility of this fund is dramatically higher than the category or the S&P 500. Its standard deviation comes in at 15.5, whereas the S&P 500 is 13.33, and the category is 13.85. So it's a riskier fund. It makes the same or less than its peers. It costs more than its peers. And here's the rub. It's inherently more dangerous than its peers because they have 30 stocks in the portfolio. 30 stocks in the portfolio. That's all. That means that if one segment of the economy, and lots of these are tech, lots and lots of these are tech, if one sector goes crazy, you could lose a lot. Even the big tech companies, they can go bankrupt. It's happened before. Remember MCI WorldCom? They were a tech firm. They went broke. They went bust. So you never know. And it reads like, part of it reads like an S&P 500 fund. They have, they have Alphabet, they have Amazon, they have Cisco and Adobe and Comcast, and it's a large cap fund with only 30 stocks in it. So why would any advisor want to sell this to his or her clients? I don't know. If somebody does sell this to their clients, to my mind, it violates their oath of fiduciary duty to their clients. Why would you sell someone a large company growth fund for 1.25% that does as well or less well than just a large company growth index? And of course, you know to whom I'm going to compare this, don't you? Yeah, I'm going to compare it to the Vanguard Large Cap Index Fund. While the other fund had expenses of 1.25%, the Vanguard Large Cap Index has expenses of 0.05%, or 1.2% less. I mean, that's just huge. It's huge. And how about the performance? Shall we take a peek here? Well, the 3-year return is actually over 14%. They actually did better than their category. And their 10-year track record is over 13%, just like those other guys, but for a lot less money. And how about that little standard deviation where we came in at 15.5% for IWIRX? And by the way, the symbol for the Vanguard Large Cap Index Admiral Fund is VLCAX. The difference is huge. 15.5% was the volatility rating, the standard deviation of the other fund, the actively managed fund. This one, 12.2%. And as for the portfolio, well, instead of holding 30 stocks, they own 605. Now, they don't have the international stocks that the other has, but you can always add a large cap or a large cap international fund and get those if you want. Or you can do even better, and you can just get the Vanguard Total World Index Fund, VTWAX, which we talk about all the time, which has an expense ratio of 0.1 because it's got international stocks in it. So it's a little higher, but it's 1.15% lower. Its performance is very, very, very similar. When you go back years, its volatility is very similar. But the cool thing about the Vanguard Total World, it's got U.S. and international, and it owns about 8,135 stocks. So would you rather have 8,135 stocks or, 30? Oh, and the other thing I forgot to mention is that the Guinness Atkinson Global Innovators Trust is actively managed. So active managers can do better than indexes once in a while, but generally there is no reason why they should. There is no skill attributable to actively managed funds that can be found in any scientific study done. So they're likely to do as well as the index that they emulate minus their expense ratio. So what's the point? There is none. But the folks out there are trying hard to sell these things because it's their livelihood on the line. They have to sell this or they don't make their big fat bonuses. You and I really shouldn't care if they do or not. Remember, if you've got a question about an investment, about saving, about building a portfolio, about creating a future plan, about avoiding being ripped off, you should call your questions in 24 hours a day, 7 days a week. So whenever you hear the podcast, you can go, oh, I have a question. Call 855-935-TALK, 855-935-8255, or visit our website, talkingrealmoney.com, where you can find all kinds of cool stuff. You can even set up an appointment to talk with one of our advisors for free with no pressure. I promise. If I've lied about that, call me names. And you can fill out a form and do that online too at talkingrealmoney.com, or you can send a question that way. So do one of those things. Keep listening to the podcast. Tell everyone you know, please, 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 like put it on Facebook and stuff. Twitter it, tweetalize it, whatever. Make it do those things. LinkedIn. And subscribe to the podcast on your favorite podcast service like Apple Podcasts. I think I'm getting a frog in my throat. Thank you very much for listening. I am getting a frog in my throat. And we'll have more for you coming up real soon. I'm Don McDonald.
Talking real money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That's a wrap.